want to bring in John O'Donohue. He is head of equities at Cowen. He joins us now from the New York offices. John, put this in perspective for us. You run the block desk at Cowen. What kind of blocks, what kind of trading are you seeing this morning?
Well, good morning, guys. I think what we've seen over the last few days especially is a lot of fear that's been exhibited in the marketplace. And, you know, from the standpoint of customer flows, obviously the prior days on Monday, we were probably 3 or 4 to 1 on the sell side. Yesterday, it was about 3 to 1 on the buy side, but without what I would call a lot of conviction. And I think the issue that you have right now is that the marketplace, not only in equities, but I would say more specifically in fixed income, is in such turmoil that I think a lot of both financial intermediaries and financial professionals, so to speak, will be moving to the sidelines for a little bit. So I expect things to remain fairly volatile, and the reason they're volatile is because there's less players involved, and when that happens, you get wider price swings.
Hey, John, clarify that point. It was an interesting one you made about equities based on the fixed income markets. Fixed income markets in such turmoil. I mean, we've only seen the Treasury market really go in one direction, right? Prices higher, yields lower. Are you talking about the credit markets in fixed income or Treasuries, and is this a reallocation?
No, I'm talking about the credit markets in general. Now, having said that, the fact that the 10-year could move from a 2.30 yield to a 2% yield and then back to 2.30 in the same day is kind of ludicrous. Those markets don't move like that. What I'm talking about are credit spreads that have blown out in some decent paper, some decent BB, high yield paper where you know, you can probably get paper around 7.5 to 8 to 9% for 1-year maturity, which tells you that there's a lot of uncertainty that's going on in the marketplace. What strikes me about that is that there's more of a buyer strike than it is necessarily a rush to liquidity. So at some stage in the next few days here, we do need to see some stability come back in that marketplace before I think the equities market itself can calm down.
Now, John, on your desk, what kind of selling are you seeing? Is it guys who are shorting, or is it large accounts that are saying, I need to pare back my exposure?
I think it's a blend of everything. If I was to characterize what we saw yesterday, I think it would be more buying of high conviction names. So whether it's the healthcare names, you know, the big ugly drugs, so to speak, that pay dividends and have got nice international exposure. I think we saw a lot of that activity.
But what about today? What about today? Because right now we're down 375.
Yeah. Well, believe it or not, today, if you look at the volume, I mean, it's a blend right across the board. I don't think the mutual fund complexes are doing an awful lot. We have not seen that across our desk. I think what you'll see is probably, here we are at 10:20 or so, you'll see people probably reassess around 11 o'clock as to what direction they think the marketplace is going, because believe it or not, you know, as we look almost on a minute-to-minute basis, which is a terrible way to even think about investing, the swings that we've seen are incredible. So I don't see, with the desk behind me, a tremendous amount of activity. I think stocks are getting marked down back into that range that we came from, down to 1100 in the S&P, up to 1175, and we're bouncing around the middle, but we're not seeing an enormous amount of activity right now.
John, again, it seems like the accelerate. It doesn't seem like the selling's accelerating. It is accelerating. What's going on?
Well, I think there's, you know, as we said earlier, there's such a level of confusion in the marketplace, both in the fixed income, the credit markets and the equity markets right now, that I think we have both a lack of conviction out of Washington, and I think we've also seen from the financial markets a lack of confidence in Washington. So if you take both the ECB and Washington together, and I know you've spoken a lot about the Fed this morning and about the 3 dissensions and about the fact that there's a firm date in place for an extended period of time of low interest rates, I think the market is trying to tell you here that even if you look at PE ratios, you know, if you look at S&P earnings of 105 for this year and potentially bigger numbers next year, that the marketplace is getting back to a much lower growth, if not recessionary type environment. And, you know, with the S&Ps here around, say, 1100, 1125, if one assumes that 105 is the earnings number for that, so we've priced in a much lower multiple. So I think what you're seeing right now is the marketplace trying to grope for a bottom, trying to figure out exactly where the right numbers are.
Yeah, always a lot of volatility, John. Agreed, whenever the market tries to find its footing. And we've got a lot of these revisions coming in. All right, thanks so much. John O'Donohue coming to us from Cowen & Company, head of equities trading there.